He is still overweight equities. For more, we're joined by Roger Groebli. He helps to oversee more than $80 billion in LGT Capital in Singapore. Good to have you with us yet again. And you know, Josie, we're talking about tightening. Economic tightening seems to be the theme in the market, but you think that it will not disrupt growth. Instead, it will revive growth. Well, what's the thinking behind that?
Yes, first of all, currently we play the economic news flow against the market, because the markets now is really in a critical territory. It's very close to the 200 days moving average, means that the market cannot take much more bad news. Otherwise, we will go into, I would call it, a bull market correction. And this can take us quite severe, another 5–10%. This is a fact, this is the market. But on the other side, I think that even though U.S. employment situation looks still grim, I think that the Fed will try to be neutral rate. What does this mean? Neutral rate means that the real rate plus inflation will be around 4%. And this takes quite some time. So I think we see quite some stability. And certainly the government has to watch out that they can finance all the mortgage-backed securities. They have to see that the fiscal situation will improve. And I do not think the Fed is going to kill the recovery now. But of course, this verbal attack from Obama last week, that he wants to ban the investment banks from proprietary trading, caused a lot of volatility. But this will calm down a little bit, I would say.
The talk now is about exit strategy. We've seen Australia. Let's talk about India as well as Korea. I mean, what's your sense of whether government are moving fast enough?
Yeah, I mean, the gravity and the speed of this change of the monetary policy, of course, is in the limelight of the debates. But I think that it's a little bit of an overkill. And you have to compare the different stimulus packages with each other. For example, China had a complete different situation. China boosted the credit volume last year by 35% of the GDP and infused direct money into the economy, while the U.S. in the peak, they only had about 7% credit growth from the GDP. So a lot of the stimulus money in the U.S. is still not working in the economy, is still aside and can still be used for emergency case. While in China, the situation is different. And even in other countries which are not pegged to the US dollar, like for example India, the situation is even more difficult because they're facing a stronger inflation, and if they're going to reduce the money inflow, they have to increase interest rates, which of course will kill the market. So I think this is going to outbalance within the next couple of months.
So what now? What needs to be done? Because we've heard from Groebli, we've heard from people like George Soros even that, perhaps, overheating is happening, there are bubbles in the market, both in China, gold, commodities, a lot of bubble talk right now.
Yes, the problem is, or maybe the problem and the chances, the problem is that it's not the private household who recovered fast, it's the companies. So they have a lot of cash now in their balance sheet. And this will going to go at work now. We see that CapEx spending is going to increase. We will see definitely more M&A activities in the next couple of months. And I think this will lead actually to increase also the wealth of the private household after a while. So I think the entire bull market or the entire recovery is not really stressed now. It's only you have different speed and different environments which have to be adapted. And of course, the Fed wants to make sure that the banks, even though the earnings increased substantially from the lows, the banks are not taking a risk which they shouldn't, and that the recovery goes smooth and not, as you said, in bubbles, and that the road will not remain as bumpy as it used to be now in the first couple of years.
So a bull market for stocks for how long?
For how long? I would say as long as the earnings can deliver the current price level. And this is the case in Central Europe. This is also the case in the US for the S&P 500. We've saw that about 40% of the companies out of S&P 500 reported yet. And we've seen that especially industrial companies, consumer discretionary companies, and as well as also basic materials, apart from Alcoa, they did pretty well. In India, for example, obviously the quality of the earnings did not match with the high expectation. Therefore, we see India is going to correct more. China is a very mixed picture, and therefore we are ready to invest more money into Chinese market. But what we said in December, also in the interview, that we focus currently on US market and Central Europe. This is not going to change.
Roger, I want to bring up the Bloomberg right now. Using the Bloomberg's market cap analysis, if we can bring it up, we found big cap stocks worth $10 billion or more to be trading at the lowest or cheapest earnings multiples. I mean, they've also have the lowest PEG ratios, price to earnings growth. You seem to like the larger companies compared to the small and mid caps. Why is that? What's the thinking?
We are going to shift, actually, because precisely what you said, in particular the second half of last year, we saw a huge difference between the performance of large caps and small and mid caps. Small caps did much better, and now the earnings has to deliver as well. But we see now that the interest of the investors is going to move away from the small caps more to the large caps, and also a little bit more into defensive stocks, from the technology stocks more to the defensive, because indeed the strategy was right to be overweight in technology, because the technology sector delivered the best earnings.